my objective with these conversations is not to make them sort of standard run of the mill. What do you think about markets? More talk about process, how to think about investing, and obviously help people get out of their echo chambers. Liz, I appreciate you doing this as always. For those who are not familiar with your background and what you do at SoFi, just set the stage for the audience as far as everything that you're involved in.
Sure. So I'm the head of investment strategy for SoFi. And what that means is that people get confused pretty often about whether or not I do anything with the SoFi stock. I do not. What I do is provide an objective voice on broad markets and macroeconomics and the connection between the two, which I think is something that most investors really can benefit from. So, watching what's happening in the economy and trying to connect it to the movements in capital markets as best I can. And I put out all kinds of content in every shape and form that people might want to receive it. So, that includes podcasts, written content, lots of Twitter content. I do broadcast media pretty often. I do things like this. So, audio, voice, I mean, all of it. However you want to get it, I'm sure that I put it out in that way. So, always just here to help and answer questions and give my take on what's going on.
And prior to SoFi, what were you doing?
Prior to SoFi, I was at the Bank of New York Mellon as an investment strategist, working with the distribution team to do much of the same. So setting up the environment, what we see as risks and opportunities. It's just that there I was tied to more of a sales force and we were positioning products in the end, but basically the same sort of material from me.
Okay, so I've been doing these spaces since the day after Thanksgiving, and I don't recall hearing anybody ever say objective voice. And I know this is going to sound like a strange question, but I do wonder how easy it is or hard it is to be objective when we know from a lot of behavioral studies that the moment somebody invests in something, they tend to believe in it more. When you talk about fund complexes, there's always the subjective nature to want to talk up your own book if you're only long only and talk about your themes that are core to what drives your revenue. Talk about from an industry perspective, how challenging is it to actually be objective?
Well, first of all, if this wasn't hard, it wouldn't be any fun. And I think that there's definitely a challenge that every investor goes through, particularly the ones that have a voice so consistently in the market, to not fall victim to your own biases. And I think that's probably the largest challenge. So the first step of trying to overcome that, or at least try to remain objective, is to know what your own biases are. I tell my analysts this all the time. The first crisis that you go through, the first prolonged bear market that you go through in your career will shape you, and you'll never forget it. And you will probably have biases because of it. And that's one big thing that I always try to remember when I'm making calls about the market, when I'm making statements about which direction I think the macro environment is going to go. But to your point about, I've always been representing a company. And at SoFi, it's not necessarily representing a particular product that investors would go out and buy. We do have an ETF suite, but I don't talk about it very often. But it is difficult sometimes to sit back and remember, okay, I work for a fintech firm, or I work for a firm that is pretty present in the technology space. And obviously this year that's been a smidge more challenging than the last 2 years. So that's something that has been, on my mind constantly. It's funny, I probably think harder about the comments I make on fintech or on tech because of that. So it's almost as if you avoid it. You avoid talking about it because you're afraid you're going to come off biased. So I would say I think harder about those comments, and I try to run them by people just to make sure that I don't sound biased, even if I don't intend to be.
And in fairness, it's a very hard line to walk, right? Because at the same time, you want, the audience or anybody that listens to your analysis or mine, they want to know that you have skin in the game, that you're not just saying something haphazardly, that you actually do believe in it. But
Right.
Again, I go back to it's always challenging to kind of walk that line. Now, that gets into a little bit of a discussion. And by the way, I love that point about your first crisis is what will shape you, right? I'm a big believer that along those lines, what defines you is not your successes in life, it's your failures, right? More than anything else. It's always those pain periods which never leave you. And anybody that lived through 2008, every time that there's a decline, they immediately think it's like 2008, which we're going to
Hmm.
talk about a little bit with this environment. Now, I named this space stock market bottoms and crashes, and I had some people say to me, well, that sounds a little clickbaity, but it is
Hmm.
an interesting thing I think we should talk about because there is this bias to want to call the exact inflection point, the exact mile marker that something big happens. Let's talk about, first of all, why do you think that there's this sort of temptation by investors to want to pick the exact moment in time that markets top or markets bottom, and how do you maybe get out of that bias as well?
Well, I think every investor, not maybe not every investor, but many investors want to be optimistic. And the optimism of it comes in realizing that okay, we've been in a pretty prolonged downtrend. This feels painful. It feels like we're in this slow burn and we're all looking for a reason to say it's going to be over soon instead of sitting back and sort of surrendering as if to say it may not be over soon. I don't know. We're just going to have to go through this for a long time. I think there's an optimism that people want to have. So calling that inflection point is something that is tempting. And I wrote in my most recent piece that it's become, calling the bottom, trying to call the market bottom is almost as contagious now as trying to call peak inflation. And it is tempting and it is contagious because we all want to be right. It feels good to be right. It feels good to call something or to look at the data and say, "Oh, okay, so this looks like the last time that this happened and change should be coming." But in reality, if you call it, regardless of what the data is that you're looking at, if you call it correctly, a lot of that is luck. And it's not something that I think is useful to most investors in the present moment because you don't really confirm it until we're, let's say, a month past it. And the peak inflation piece, I think, is the most interesting thing that people are trying to call right now because we had 1 month of lower inflation than the previous month. So now everybody's saying, okay, here we are. It's done. We saw the peak. But one data point does not make a trend. That doesn't confirm that we saw the peak. Maybe it went down a little bit, but that could have just been because energy relaxed a little bit. What happens next month, right? You don't know that yet. So there's no sense in trying to invest based on something that may or may not be true in the next 3 days. So how do you avoid it? You have to think out. I actually hate using the words long term because I a lot of times think it sounds from people like me like an excuse of why we're wrong in the short term. But you do have to think out longer term than 30 days. And volatile markets will make you think in a 30-day period. So force yourself to think in quarters, force yourself to think in a 1 year period. Do I think that the VIX is still going to be this high for the next 12 straight months? No. Do I think that inflation will have been confirmed that we peaked at some point in the next 12 months? Yes. But who cares if it's this month or next month? You shouldn't be changing your investment philosophy based on that.
I love you said that because every now and then I'll sarcastically put a tweet out when there's a big update, and I probably do that today, saying, "Well, I guess the bear market's over." Right,
Right.
because of that very short term movement. Now, you use the term slow burn, and I want to hit on that a little bit because I can make an argument that we have been in a slow burning environment for all asset classes for a while. Okay, so you've had, as I've been making a case, I think a bear market that started February of 2021. That's when breadth peaked and you started seeing real deterioration underneath the market. That's been a slow burn. You've had a slow burn with bonds in terms of negative real yields, and now the capitulation with the yield spiking and collapse in total return in the bond market. You also had a slow burn with commodities in terms of underinvestment and lack of interest, and then gradually picking up, and then the spike that we've seen. When you're in cycles like this, where it's one of those things where nothing matters until it matters, and then and then when it matters, it's the only thing that matters. How do
Hmm.
you think investors should think about a process to analyze? Because if you go back to exactly what you said before, there's a degree of luck in obviously trying to call an exact top and exact bottom, and oftentimes that's not driven based on process, but kind of more some kind of gamification aspect to think about markets. How do you try to get people to think about a process when you're in such a weird extreme environment for their own investing?
Well, the first thing I would say is valuation is a terrible timing mechanism. And although we all keep talking about it, how the PE on the S&P or on the Nasdaq or you name it, the stock, whatever stock you're looking at, yes, they've all come down, so we can confirm the fact that they're not as frothy as they were 6 months to a year ago. but it's still a terrible timing mechanism. So take that not necessarily out of the process, but that should not be your short-term decision factor. When you think about a process in an environment like this, one of the things that I think is always difficult for investors, self included, is to figure out whether or not we should even be doing anything. And sometimes when volatility is so heightened and you've got a lot going on in in the moment, and we know that we have more coming in the near term horizon. We've got two more Fed meetings, we've got another CPI reading before the next Fed meeting, and we've had one quarter of negative GDP. There's a lot of uncertainty out there. And there are times in your investing life when you shouldn't really do anything. I think, unfortunately, this is probably one of those times for a little while. Now, what I try to think about in a process, if I start to get antsy and I want to buy something, because I do feel like if we look back on this 5 years from now, some of this is going to look like a real bargain. So then I think about, okay, what's my thesis? Always think about what's your thesis around an investment. If your thesis is based on the fact that people are talking about it a lot, that's not a real thesis. So, what is my thesis as an investor about a certain theme? And what does that theme look like today based on attractiveness versus maybe what it looked like 6 months ago? So, I'll take something like electric vehicles, for example. They've been beaten up quite a bit. We just went through earnings season, and I think that the EV manufacturers, both traditional and new, are facing increased costs, as many companies are. But the theme itself over the next 2 to 5 years, only growing. And if you look at the number of vehicles that consumers are purchasing that are electric vehicles or that are more sustainable minded, only growing. And that market is not yet saturated. Now there's some infrastructure that we need to figure out, and there are hurdles to it, and there are components that aren't available, and you name all the headwinds, that's fine. But that theme in particular is only increasing, and right now it's trading at a pretty attractive multiple compared to where it was 6 months ago. So then thinking about, okay, could I buy that theme right now and leave it alone for 2 to 5 years and feel good about its prospects? Yes, I could. So that's the way that I try to think about things, by avoiding the short term of, okay, where's something trading today? What did Tesla do today? Or insert stock name here. Think about it more as, what's a theme that I like for the next 2 to 5 years? And can I afford to buy that right now?
I will say also that this idea that sometimes you just shouldn't do anything, part of that is also sometimes you shouldn't change anything in terms of whatever process also you're following. And
Hmm.
that's something that hits close to home for me, especially this year. And I always use that line: your ability to stick to a strategy matters more than the strategy itself. You cannot avoid drawdowns. Every strategy, every asset class will have those tails. The question is when they happen. Now, this year, you can make a case that they've all happened in this at the same time, which is what's really kind of a tale of all tales, so to speak.
Yeah.
But now, let's talk about that 5 year horizon for a moment when it comes to
Well,
crypto.
can I
Yeah, yeah,
actually,
please, please.
I want to add something to that, because this is actually a really interesting point. So I spent 4 years as a due diligence analyst before the Bank of New York Mellon days. And I think that this is something that a lot of investors don't have the benefit of having gone through. So when I was an analyst, I went through, we managed the discretionary models for the company, and we also managed the recommended list of money managers and mutual funds. And you cover certain asset classes, and then it was my job to interview the portfolio managers of certain mutual funds or separate accounts, know what their philosophy was, know what their process was, know how their performance has been, and be able to set expectations for investors about what to use that strategy for. If a manager violated their own philosophy or violated their own process, that was a knock on them. And one of the things that we always used as, I really like this manager, or this is a durable manager, was that they stayed true to their knitting, right? They stayed true to what they told us they do. That doesn't mean that their strategy is going to perform well in every environment. In fact, it shouldn't. If a manager ever came to me and said it's going to do well in up, down, and sideways markets, I'd be like, next, there's something's wrong. Something's not working. Because the way to choose a mutual fund or an ETF or whatever strategy you're looking at, even setting your own strategy, is to be able to set the right expectations in different environments. And there were times that managers would underperform, and we'd have to sit back and say, okay, but should it be underperforming right now? And if the answer was yes, nothing's wrong, nothing's broken. It's doing what you would expect it to do in this particular environment. And I think that's really difficult for a lot of investors to watch in their portfolios. Let's say you had a lot of technology in your portfolio, or you had a theme that you really believed in, I don't, cloud computing, whatever it is, and been in the red for a long time. It's easy to think it's broken. But if you look at the environment that we're trading in, the environment that we're going through, should it be underperforming right now? If the answer is yes, that's okay.
I love that because that's unequivocally the proper way to think about analyzing any investment or any strategy, because in any single roll of the die, your strategy, your investment can go through a severe drawdown, right? Especially if you're in an anomalous environment. But at the end of the day, if you really are going to be an investor in anything, you have to look at it from the standpoint of multiple rolls of the die, right? I always make this
Mhm.
point. We live in the small sample. Markets and live in the world of long cycles, right? And that goes into sort of this line I occasionally tweet out, that what you own matters a lot less than how much you own of it. And that's a
Mhm.
good transition to what's happened with cryptocurrency and a discussion around leverage in the way this tail wagged. And I'm going to have Crypto Bull come up in a second, but I want to just set the stage on this discussion here. I go on these long rants sometimes, obviously on Twitter, about terminology, store value, inflation hedge around cryptocurrencies, Bitcoin. And people constantly seem to think that I'm anti cryptocurrency, even though the irony is that I want to see the space actually do well. But for any investment theme to do well, you have to, over time, wring out uneducated speculation. And that uneducated those speculators tend to employ a lot of leverage, and they tend to have these narratives around their thesis, which makes them believe even more that the thesis will play out not in 5 years, to your point, Liz, but tomorrow. And
Mhm.
that's where a lot of people get into trouble. So I want you to just talk through a little bit your thoughts on what happened this week. If you could say that this was coming, if you could say that this is something people shouldn't be worried about, or if it's just sort of a cautionary tale of being too overly convinced.
So when you say this, do you mean
The tail,
something that?
these collapses that you saw in Luna and Terra, and
Yeah, well, and
Bitcoin
the
collapse, right, in general.
breaking the dollar, that sort of
Right,
thing.
all that, right.
Yeah. Well, okay. So one of the things, and I'm not anti-crypto either. I mean, we do crypto trading at SoFi, and I own it in my personal account. So I want to make that very clear. I want to see it do well too, but I'm at I'm at a pretty big unrealized loss right now. But if you look at it, I think Twitter is an interesting platform to look at when this happens. So you see like a big drawdown in crypto, and suddenly all the crypto Twitter sphere comes out, and the statements end up being things like, oh, you guys just don't get it. Okay, well, but as an investor, if I own something and it's down 7 to 10% in one day, I see the number and I get it, right? I get the fact that that's painful. And then you start to wonder, and this goes back to sort of the previous discussion, should it be performing that way in this environment? Should this have happened? Should we have seen this coming? Really, the question you should ask yourself is the thesis busted? So the thesis that I purchased this under, is that thesis busted? Now, if you bought crypto with the expectation that it was going to protect against inflation, that obviously has not done well this year. That's not gone the way that we expected. If you bought crypto because you want to participate in this decentralization of the world and have an opportunity to pull away from all the control that the central banks have, and you're looking at it from that perspective, I think that's still in place. Now, that doesn't mean I don't think there's been anybody out there that said crypto's not a volatile asset. I mean, it's up. Bitcoin's up what, 7.5% today, 8% today. That's a good day, but that's volatility. Volatility also happens on the upside, and for people that put too much of their portfolio in it, this has been especially painful. That's where you have to be careful about. All right, this is a new asset class. If I'm using it as an investment, as a portion of my overall portfolio allocation, make sure that you have a smart allocation to it. And if you put 20% of your portfolio in it without having set the correct expectations or realistic expectations, then this is probably a tough lesson to learn. So I think to your point, it's more about how much is in there rather than what exactly is in there. I think crypto as a whole, because it's still so new and we don't have the history to understand how to set the right expectations, it's going to continue to go through some boom and bust cycles. It's going to continue to go through price discovery phase. And if you want to stick to your guns and stay invested in it, then you have to be ready to go through those phases.
No, and that's why my war is often on words and the way things are framed, right? Because it's not that I'm trying to poke fun at the term store of value, but I do believe terminology like that is actually very dangerous because that makes it seem like you can put a larger portion of your portfolio than might be appropriate for your risk tolerance in that asset that seems like it's stable. That's a store of value, in quotes. And people then respond and say zoom out. Well, those that's you're talking about an investment that goes up over time or it has gone up over time. You still have to weight that properly. And for the life of me, I can't understand why people don't see that words matter and that it's actually very dangerous and counter to the longer term objective of having widespread institutional adoption of cryptocurrency. Because if the wrong words and wrong ways of framing cryptocurrencies are out there, and that creates a false sense of confidence in the asset class in terms of the sequence of returns, sequence of purchasing power potential, well, then that results in the same boom and bust cycle we keep seeing over and over again in every asset class. Overconfidence, leverage, crashes. Overconfidence, leverage, crashes. And that just prolongs the entire adoption. I don't know. Just for me, I don't think people have thought this through in terms of the way they frame it.
Yeah, well, and I also don't think that, again, I don't think it's been around long enough for there to be a solid base of investors. I mean, there's a small subset of investors who are not new crypto investors, but the majority of us are pretty new crypto investors. And when you're new to an investment, it's difficult to really stick with it because you don't entirely understand everything that might affect it, and we're kind of learning as we go. If you look at, companies that have been around forever, or maybe sectors that have been around forever. I'll take industrials for example. I think the industrial sector is full of companies that we're all very familiar with. We know exactly what they do, even if we're not buy side equity analysts. It's pretty simple to go look at the biggest 10 companies in the industrial sector and say, you know what, I'm familiar enough with that, and I can probably set decent expectations for what it will do in different environments. I know what drives its revenue. I know what drives its headwinds. I could listen to the CEO talk and I get it. Right. And I'm painting with a broad brush, but I think that's reasonably true. Crypto is different. And it's not just crypto as a whole. I think Bitcoin X different than Solana, and that X different than Ethereum. They're built on different premises, and it's difficult as newer investors to look at that and really stick with it through the storm. So I think you're right. It probably does prolong some of the adoption. Now, I don't think that institutions are going to be that wishy-washy about it. That's just not in their nature. So I don't think they're going to pull out of it and run for the hills suddenly, but it probably prolongs the adoption for the individual investor. Yeah, so I'm going to try to keep this to as succinct as I can. I was disappointed with the 8.3 CPI print this week. I thought that it would have come in closer to expectations at 8.1. And your point about the services inflation side, that's actually exactly what I wrote about in my weekly column that went out yesterday. Because when you look at the composition of what the number was this time, services is now the largest component of inflation. And that matters because services inflation is stickier. Goods inflation, I want to say waxes and wanes, although it doesn't really feel like that's been the case, but it waxes and wanes a little bit more with supply and demand. And we've pointed to some of the drivers of that over time, which is we've got, supply chain issues. We're all well aware of this. I won't go through all of it. But services inflation is stickier. And once that inflation gets passed through to consumers, that makes it permanent for the moment until you've got a break in the economy and companies have to pull back on their pricing. Now, this is an anecdotal example, but if you dig under the cover of services inflation for this month, you'd find that airfare went up 18% month over month. That's month over month. So we just got April's inflation reading. Since March, airfare went up 18%. Year over year, it's up 33%. I just came back from a trip to California. I flew back on Wednesday night, and it's a big plane, right? Every single sorry, I have an alarm that went off. Every single seat was full. Every single overhead bin was full. People in line were complaining about how expensive their airfare was for economy. But the reality of it was they still bought it. They still paid it. So that inflation, and especially that services inflation, isn't going to come down until demand sees some destruction. Now, I know the word destruction seems dramatic, but right now the reality is that demand has not seen that much of a pullback. So inflation has stayed high. I think that we will start to see a pullback in demand in May and June. Maybe we start to see it in May. And where do you find that? You find that in things like retail sales, you find that in personal consumption expenditures, you might find that in new orders that come out when you see the PMI prints. So I think we'll start to see some of that pullback, but consumers have been on this revenge spending rampage because we can finally go out and participate in the economy again, and everybody wants to do everything. People ask you to go to a concert, the answer is yes. It's like, I don't even have to know who's playing. Oh my god, I'm so excited I can go see music again. So there's been this revenge spending, and I warned about this earlier in the year, that when everybody says the same thing about what's good, you have to question it. And earlier in the year, everybody was saying, well, the consumer is so strong. The consumer has 2.5 trillion in cash. Okay, what could happen? And it could happen very quickly, is that the consumer spends that cash down and starts to buy things on credit cards. And it just started happening. If you go pull the data on revolving credit, we've seen a huge spike in the last 30 to 45 days. So I do think demand will start to come down, and that will bring inflation down. The real question, though, is we're at 8.3. We really need that to be closer to 3 or 4 before it's comfortable. So it needs to come down on a much steeper slope than this.
So it's essentially the revenge of the revenge spending is going to be at some point increased default risk, right? Because if this spending is just going on credit cards,
Hmm.
and if this inflation is just being paid not by cash but by credit, then the cycle then goes back to maybe sort of another deflation or recession scare, which is what I think everybody is starting to talk about. When you look at consumer spending versus the supply chain discussion, which do you attribute more to inflation now? I know you can look at the data and look at the services numbers and try and get a sense of what's going on with consumers, but on one hand, you've got people that say it's purely about supply chain, and on the other hand, you've got people saying it's purely because whatever a quarter of all dollars are printed since COVID. Which do you think it matters more to this inflation question?
Now I think it's the latter. Now I think it's the consumer demand piece, and the fact that we got used to having so much money flying around in the economy. I mean, the very basic definition of inflation is more money chasing fewer goods. So for a while we definitely had fewer goods, and we still do, but it's not as bad as it was before. And if now we're seeing the services inflation side of it be the real driver, that's not as much a supply chain issue. That may be partially a labor shortage issue, but we're not seeing services inflation because we can't get coffee tables on time anymore. So the goods piece has become a little bit less of the driver. And now, and this is what the Fed is trying to do, the Fed is trying to affect demand. So now what needs to happen is that demand needs to relax in order to bring the entire inflationary picture down.
Okay, so now that actually goes a little bit back to the title of the space, because it seems to me that, and I've put this tweet out before, got quite a bit of engagement. The stock market will break inflation faster than the Fed because of the reverse wealth effect,
Hmm.
right?
Hmm.
Now, you've had a lot of damage in stocks, but you've had far more damage in the bond market. And, bonds are kind of an interesting asset class because there's a little bit of that behavioral finance mental accounting that happens where people think that as long as you keep getting that check, you're fine. Who cares about the value of the underlying bond itself, right? They kind of, in their mind, separate the two, even though with all investments, you should really think about it from a total return perspective.
Hmm.
How much destruction needs to happen in equities from here, you think, to really have that demand destruction the Fed wants to see? Because at this pace, the Fed is not going to be able to get us to positive real rates. It seems that market forces have to do it for us.
Well, if you ask the Fed, it doesn't matter what happens in the stock market, right? And that may be directly true. They may not necessarily say, okay, the stock market's going to go down another certain amount, in which case we will change our approach. But you're right. There is that wealth effect that I think everybody needs to keep in mind. So I'm going to take it from a kind of bear market recession standpoint. So if you look at the S&P, for example, right now, since that peak on January 3rd, still only down about 16%. At most, it went, I think it got down to maybe 17 or 18%. That in reality is not that bad. Now, the NASDAQ is down more, and the NASDAQ's been in bear market territory, so over 20% pullback for a while, and it kind of flirted with down 30%. That's where you start to get to the point where it's like, okay, this might be enough, right? The NASDAQ, let's say the NASDAQ crosses 30% down, is in the low 30s from peak to trough. That starts to feel like enough. Now, that means nothing, though. The fact that I feel like that's enough. I'll admit I was wrong a couple weeks ago. I thought before this last Fed hike, I thought that we had priced in enough negativity that once the Fed started going at 50 basis points each time, the market would sort of level out. Now, we obviously had a huge rally after that meeting. It was this relief that we got it behind us, and then we gave all of it back and then some within 48 hours. That surprised me. So at that point, my feeling was incorrect. And we've now realized that the sellers were not entirely exhausted yet. But I do think that we're getting to a point where I don't know who else is going to sell some of this stuff. So, the S&P kind of flirts with that 20% down mark. It's happened multiple times in the past where if you're not in a recession, 20% hitting that 20% down mark is right around when the S&P bounces back. If you are in a recession, you see the S&P down more than 30%, 35, 40%, something like that. So in this scenario where I don't think we're going to see a recession this year, then 20% is about enough. NASDAQ, you probably need it down about 30, and then you can level out. Now, that doesn't mean we're going to end the year positive, but I do think that the second half of this year will be less volatile than the first.
And that goes a little bit to what I alluded to in the copy for the pin tweet about the space when I said could stocks crash next week, and I wasn't just saying that again haphazardly. So in my world, I always frame things in terms of conditions, right? The conditions that favor an accident, which is those major tail events in equities, and you've had a decline in the headline averages, but you have not had that capitulation in what technicians would normally look for to mark a potential bottom, or at least the conditions that would favor one. The sequence of returns here, I think, is really interesting in that you've had for pretty much the bulk of the year the defensive late cycle sectors, most notably utilities, consumer staples, and healthcare, outperforming. And usually, when they lead, and it's not my opinion, I put out research studies that quantitatively show this. Usually, when they lead, they tend to lead in advance of the major big declines. Most major crashes,
Mhm.
corrections, bear markets are preceded by strength in defensive sectors, weakness in lumber. The strength in defensive sectors has been ongoing for a while. Only now is lumber starting to weaken because suddenly the market's realizing that, well, housing's in trouble, right, with this
Mhm.
mortgage rate spike. Do you think that, going back to that term slow burn, do you think that this is going to end quietly, or do you think that this could end up being one of those things where you could get a real whoosh and then it's game on for kind of a more normalized environment? Because I keep looking at this market, I say to myself, I don't see how much longer this kind of cross asset volatility can persist without something really, really breaking. Into your point, there's such a buyer strike out there. Who else is there left to sell? Yes, you're oversold, but crashes do tend to happen from oversold levels.
Yeah, I actually don't know that we're oversold yet. I mean, I think we're close, but and I don't want to get into the argument about what that really means, but I don't know that we're oversold yet. Now, is there going to be a huge crash? Do I see a huge crash coming after this? No, I think it's been crashy enough. But I also don't see, a rip your face off rally that's going to just start in the second half of this year and go through. And the other thing that we haven't talked enough about, not just on here, I mean, in general, is the fact that we've got midterm elections coming up. And the market does not like midterm elections. So going through the summer and fall or early fall before the midterms, the market usually struggles quite a bit. And you don't see that rally or that kind of relief until November and December when the midterms are over and we have a little more certainty. So even if we level out from these volatile periods, I don't think that we're going to see a huge sustained uptrend necessarily. It may just be quieter than it was in the last couple months. But also
It,
to be fair, the April period, so beginning of the year was tough. The April period, I mean, that was the worst month we've seen since 2008. That was a pretty big crash. That was a pretty big downdraft. So I'm hopeful that that was the biggest one. And now we may still have volatility, but I think the big dramatic one hopefully is behind us.
yeah, and it's hard to think through all that also because the small caps are obviously way oversold relative to large caps. Our type plays are way oversold, and those have crashed. Some of the China tech names obviously have crashed. So you have this sort of asynchronous type of tail movement that's happening underneath the surface, just not yet in the larger averages. And who knows if it's going to play out that way. But again, I go back to the way that this has played out. I personally, I'm just not of the opinion it can persist much longer without some kind of whoosh. But we'll see. Now, let's talk about earnings for a moment. And I'm going to ask you a very odd question: do earnings matter? And I'm saying that purely because for years the story of large caps was PE expansion. It was all about the price. It wasn't really about the earnings. Now we're seeing some contraction. Talk about how investors should think about fundamentals when you're in an environment that's so driven by macro movements.
Well, what's interesting is that we haven't had to think much about fundamentals for the last couple of years because of the macro environment. That environment allowed companies to grow and experience multiple expansion. Sometimes companies experienced it for seemingly absolutely no reason whatsoever. But I won't go through the whole meme stock thing. But it prevented us from having to focus on fundamentals. Yes, I absolutely think earnings matter. That doesn't mean that earnings are going to be the thing that drives the market or that they're always going to happen logically. What I think earnings can do this year is that now that we've gotten some of that valuation bloat out of the market, earnings can put a floor on how much some of those companies will go down further because they finally have that fundamental piece to fall back on. So we're not at these high levels where there's a huge space between what the fundamentals are saying about a company and what the market is saying about a company. Now it's come in to be a little bit more realistic. I also think that the market has reacted to earnings quite a bit. Now it's punished both beats and meets, which has been odd, I think, for investors. But again, I think it puts a floor on some of these companies, and what's happening is that whatever saying you want to use, the tide goes out and somebody's not wearing shorts, however it goes. But what it's done is that now we have to actually look at it and say, okay, what's the revenue health of this company? What's the balance sheet health of this company? What's the growth potential? And you can look out further and listen to the guidance and see what's happening with the company and what they have to fall back on in this tough environment and make better decisions about whether or not they deserve to be trading at these levels long term. So I absolutely think earnings matter. The other thing I will say though is first quarter earnings came in better than expected, which is great. Second quarter earnings are expected to be lower than first quarter. So second quarter earnings are at this point pretty underwhelming as far as expectations go. And then the third and the fourth quarter are expected to be about 10% growth. I do think that the expectations for the third and the fourth quarter are going to have to come down a little bit. You're going to see companies' profit margins start to shrink because they're dealing with inflationary pressure. I think the stat was something like 85% of S&P companies mentioned inflation as a driving force in this quarter's earnings. So you are going to see some compression there. And I think that we will see expectations come down for the rest of the year, but we don't necessarily see earnings contract. So I do still think, maybe to your point, Michael, that there's another whoosh that needs to come. I do think that some of the expectations for the year are still just a little bit lofty because they're based on earnings being strong and they're based on the consumer staying strong. Yeah. So, well, first of all, thank you for the question. When I tweeted that yesterday, Twitter really, it was completely bifurcated. Either people agreed with me or just attacked me as if I had said something so terribly offensive. I didn't mean to group retail traders in and belittle them by any stretch of the imagination. And people rightfully pointed out that there are plenty of institutional traders that do the same thing and have made the same mistakes. So let's just call it investors at large that fall into that trap. I think when you get to extreme trading levels, whether on the upside or the downside, you have what's called recency bias. And recency bias leads you to believe that things that have happened most recently are going to persist into the future. And it causes you to extrapolate that feeling out further into the future than is realistic. The other thing that happens, so this is all behavioral, it's all mental, right? The other thing that happens is that as an investor, I don't think anybody is free from this bias. The pain of a loss hurts twice as bad as the joy of a gain feels. So you lose $5, it hurts twice as bad as you get excited about gaining $5. So especially on the downside, you usually see this sort of acceleration in selling after big down days or after down weeks, because it starts to, you get the data of, okay, oh my gosh, now my portfolio's down 15%. It was only down 10% last week. I should cut my losses. And I should cut my losses and just get out of it now. The issue with that is that once you're in especially a period like this, and this is why I tweeted it yesterday, you're in a period like this where the market's already drawn down broadly 16, 17, 18%, NASDAQ down almost 30%. I would never tell people to sell into that. That's a time when, again, as difficult as it can be, you sit and you wait, because the market tends to overreact in the short term. So don't overreact with it. And you have to wait for it to come back. Now, there are certainly times, and I put this in the tweet too, if you've got individual positions, you should always have stop on them, whether you actually put that stop into the system or you just know it yourself. And that stop might be, okay, when this position is down 25% from purchase price, I reevaluate. Or maybe you're more strict about it and you say, when it's down 25% from purchase price, I just sell it. That's it. That's my cut my losses limit. You should still do that, but it's not something where just because the market has been poor for the last 4 days that it's like, oh my gosh, I have to run for the hills. If you look at, we just did this study too. If you look at rolling 5-year periods, and we only use the S&P, but I could easily run it for other indices if people are interested. Rolling 5-year periods back to, I think we went back to 1950. And we did it daily. So rolling daily 5-year periods. And we did that on purpose to account for the idea that people swing in and out because they're emotional about it. Only 7% of the time in those periods, and there were like 18,000 observations in this study, only 7% of the time did you have a 5-year period that was below zero. All of the other times, 93% of the time, you were positive. And the most likely outcome was that you were positive on an annualized basis by 10 to 15%. So that alone proves the fact that over time the market does rise. Now, there may be shorter term periods where you're flat or maybe you're down slightly, but that proves every time that you look at it, more often than not, you're going to end up positive as long as you can control your emotions, especially in down markets.
And that goes back to the discussion around process, right? Because if you have a process, your emotions really shouldn't have anything to do with your portfolio, right? Because then you're not buying high and selling low. Your process would allow you to, even in the drawdown, do what you would do when you're at new highs, right? And that consistency is critical. Now, real quick on stops, I will tell you personally, I myself don't believe in stops, only because I think it provides a false sense of confidence. But and one of the things I've seen when it comes to stop loss orders and people that employ stops is that a stop gets hit on a position. Now they're in cash, and then maybe an hour later they use that cash and buy something else.
Mm-hmm.
Right. So in other words, they don't stop themselves and step away and let some time pass before then redeploying whatever cash they got from that stop. Just talk through to the audience. How do you think about stops from a process perspective? Because it can't simply be that you put a stop in a position, it sells out, but then you have to do something, and then when do you do that something? Right. Talk through that,
Yeah.
because I think it's a nuance.
Yeah, that's fair. So, and that's why I said whether you put it in the system or not, it could just be something where as you watch your portfolio, you see something that's down 20 or 25%, and you know that you've set a rule for yourself that, okay, if a position is down 20 to 25%, I have to reevaluate it. So then you go back and look at it. And the first question you ask yourself is, what was the thesis I bought this under? Is that thesis busted? And that's sort of it, right? That's the question I ask myself very often. Is the thesis busted? Now, sometimes that thesis is about a theme. I used electric vehicles as an example before. Is the electric vehicle theme busted? No. Then, if I'm looking at a particular position, then the next question is, but is this position busted? So if you're looking at one in particular company, let's say something's happened at the company, or there's been an earnings report that was surprisingly negative, or I don't know, a change in management, you name it. The answer might be yes, this particular position is busted. In which case, okay, now we've triggered my risk limit. So let's call it a risk limit instead of a stop. We've triggered my risk limit. I reevaluated and I decided that the thesis that I bought this under and or the company itself is busted, in which case then I would still sell it. Now, what you could do, and I'd actually suggest this, what you could do is operate under the 3-day rule, which this isn't necessarily the time when you would do that. The 3-day rule is if a company falls dramatically on negative news, you wait 3 days for the market to sort of work itself out before deciding to possibly purchase it, because it can be really tempting. For example, remember when Facebook fell 25%, I think, in after hours trading, it can be really tempting to buy it and think, oh my gosh, a 25% discount, right? But in reality, you should have waited another few days because it fell further. So that's usually the 3-day rule, but you could use the 3-day rule in this instance as well. Let's say you get stopped out or you hit your risk limit and you sell a position. Wait 3 days. Let the market do what it's going to do. Think about where you want to redeploy that capital. And that's also an opportunity if you need to adjust the portfolio. Let's say you've been overweight a certain sector or overweight a certain theme. That's an opportunity to diversify yourself better. But maybe that's the right way to go about it, is the 3-day rule.
Real quick on that point about is the thesis busted? I agree with you 100%. I think and it's kind of consistent with everything we've said in this space. The issue is that you may have a thesis for an investment, but then either your time frame throws your thesis off or momentum throws your thesis off, right? And that maybe becomes sort of a good way to kind of round out the space here, which is that we talk about process for identifying how to handle market gyrations and how to think about going long, but what is a process for knowing if you're wrong? Because I think that's really important. I always get people tweeting me saying, "You seem to be constantly negative. You're constantly putting question marks around investment ideas." And my response is that the best investors tend to be the ones that try to keep poking holes at their thesis. But
Yeah.
talk through that, because I think that's really important. I think people need to question their investments more, but it's hard to figure out the right approach to do that.
Yeah. So I have to answer this sort of on a macro broad markets perspective. I do the same thing where I actually seek out people who I know have a different opinion than me. And I tend to be biased on the optimistic side, and I know that about myself. And this too, the first mentor you ever had usually shapes you. And the first mentor I ever had was a perpetual optimist about the market, and he was very long-term oriented, and that made a mark on me. So that's sort of how I operate. So then I seek out people that I know are bears more often than I am, because I want to hear why they're bearish. And frankly, sometimes they make really good points. So then I'll watch both sides of the coin. And there's not necessarily a time limit, but this just happened and I already used it as an example. I was wrong about the market reaction to the Fed meeting. And I had some friends, I do a show with them every Thursday, a streaming show. They thought the opposite. They thought we still have more to go. We're not done with this yet. There's going to be more downside. And they were right. They were absolutely right. So the other thing is not just seeking out those opinions, being able to admit that those opinions were true and yours was wrong, I think is also a really important piece. But to your actual question about how do you know when you're wrong, you don't know that you're wrong over a 1-day period. You don't know that you're wrong, I would argue, even over a 1-week period. I think you know when you're wrong when the story changed. And I know I keep coming back to this, but I would urge people, and this is from my due diligence days, I would urge people, if it helps, to even just write down your thesis about a position, even if it's just 3 or 4 bullet points. Here's why I bought this. Here's what I think is going to happen over the next, call it 1 to 2 years with this stock or with this position. And then revisit it. When you hit your risk limit, go back and look at those bullet points. Are they all true still? If they're not all true, you're probably wrong about one of them. And that's how you make a decision.
Yeah, and it's hard to do, especially when algorithms are pushing things that you agree with on your timeline, right?
Right.
You have to, basically what you're advocating is that you have to short confirmation bias, right? But that's a
Right,
very
but
hard
but I
thing to short.
also yeah, I also would say your bullet points shouldn't say something like, I think the stock is going to go up 15% in the next 2 months, because you're probably going to be wrong about things like that. I mean that your thesis about a stock should be, I think that there's growth in this space, the market is not saturated yet. I think that the macro environment is going to be tough on this for the next 4 months, but by the end of the year, things should level out. Things like that. So, but if you're putting actual, data around it and saying, I think that the stock is going to go up 10% by the end of July, you might end up being wrong about that. And that's not necessarily a reason to sell. The thesis should be more around what's the opportunity in the stock long term, what's the durability of that company, what's the durability of this theme, and then what would the macro environment treat it like. And it goes back to one of the first things we said in this space is, if that particular position is supposed to underperform in an environment like this, that doesn't mean it's busted.
From your lips to God's ears, as I always go back to saying, the one fact pertaining to all conditions is that they will change. The only thing you can control is your effort. You can't necessarily control your outcome, right? And process,
Right.
over everything, I think is critical. So everybody here, again, please make sure you follow Liz Young. Always appreciate you imparting your knowledge.